Our latest report findings reveal that collaboration across public, private, and multilateral actors, including blended finance approaches, is transforming the landscape of climate finance. By strengthening risk-sharing mechanisms, these partnerships can unlock private capital at scale and accelerate the global green transition. Multilateral development banks are playing a pivotal role as catalysts. Equally important is the growing engagement of family offices and impact investors. Let's hear from industry experts sharing their key insights.
Let me start with a few explanations on green and sustainable finance. Back almost like 7 years ago, Hong Kong initiated this program to develop green and sustainable finance. And as of now, Hong Kong has become a very large and dynamic green sustainable finance market. In fact, Hong Kong has been issuing green bonds and other green debt instruments in the amount of about 45% of Asia total. But recently, Hong Kong has focused more on transition finance. And in fact, in the Hong Kong government, which we have a steering committee that's consisting of quite a few regulators, they have formed a strategy to develop transition finance. And recently, the steering committee has come up with a practical implementation guide for transition finance. And also, Monetary Authority has issued a taxonomy that included the transition activities. Now, beyond that, the ecosystem is also working on transition finance. For example, Hong Kong Green Finance Association, which I chair, has published a toolbox, which is called repository of the transition planning tools. And the CASI, which is the Capacity Building Alliance of Sustainable Investment, has offered training programs on topics related to transition finance. In fact, recently, Hong Kong GFA and CASI has joined hands in delivering an online training program, including, I think, about 16 modules, and transition finance is a major part of that. And I think within the ecosystem, there are a lot of efforts being built to enhance the capacity for transition finance, transition planning, as well as development of transition finance instruments.
Transition finance is becoming increasingly important across Asia Pacific because the region sits at the center of the global decarbonization challenge. APEC accounts for more than half of global energy-related emissions, and many economies still rely on high-emitting sectors such as power generation and heavy industry to support growth and development. At the same time, the climate financing gap remains substantial, particularly in emerging markets. In our joint research, we found encouraging signs of momentum. APEC respondents showed the strongest confidence globally in the future growth of transition finance, suggesting that the region is not only where the need is greatest, but also where market interest and innovation are accelerating. We are also seeing the toolkit broaden beyond traditional green finance. Equity and debt instruments remain important, but sustainability-linked loans and bonds, carbon markets, blended finance structures, and transition-focused taxonomies are becoming increasingly relevant across the region. That said, challenges remain. Data quality, inconsistent metrics, risk-return mismatches, and the need for credible transition plans and verification frameworks continue to slow progress. This is why disclosure alignment, capacity building, and stronger public-private collaboration are so important. For policymakers and investors, the implication is clear. Scaling transition finance in APAC will require clearer frameworks, better data, and more effective collaboration to turn transition ambition into investable action.
Insurance has a key role to play in the green transition. By tapping into decades of expertise, we can support both the energy transition and greater economic resilience in the face of changes to our climate and our weather. The HK-IMR report highlights the role of insurance and resilience products to support the green transition. Climate risk products and parametric insurance are mentioned as enablers. This is an encouraging sign and shows that there's already an awareness of how insurance can help. In fact, there's so much expertise and data that the insurance industry is already providing, but there's still so much more that can be done. Here in Hong Kong, for example, there's a need to continue to support the buildings and construction sector with expertise and know-how, so that our infrastructure and properties can build greener, be renovated greener, and be more resilient in the face of severe weather. Supply chains and operational risks can be insured and make more resilient to climate risk, with the mantra that we should shift focus from not just building back better after severe events, but building better before they strike. There's a role for insurers to promote sustainability within society too. For example, by incentivizing repair rather than replacement of property, for example, car windscreens, mobile phones. And in wealth management and life savings insurance, there's a role for insurers to make it easier for individuals to allocate their savings and capital towards sustainable and transitionary investment projects. Finally, it is great to see the collaboration of the different financial sectors in the so important green transition. Asset management, banking, finance and insurance all coming together to incentivize, to problem solve, to provide finance and insurance, and ultimately to be a partner to the wealth of businesses and individuals as we seek to secure the sustainability of our planet for future generations.
Our research report highlights the importance of deepening regional collaborations to advance global consistency, interoperability, and shared progress in climate finance. We hope the report's findings will facilitate informed dialogue, strengthen cross-border cooperation, and support the development of the vibrant transition finance ecosystem in Hong Kong and beyond.